Everyone is staring at the AI model race, and that is understandable. Models are dramatic. They write, code, talk, reason, and occasionally hallucinate. But the quieter business story is happening one floor below the showroom. The real money is moving into deployment, the unglamorous, expensive work of making AI actually function inside banks, factories, hospitals, and supply chains. That is the undercurrent here. The next giant AI business may not look like a chatbot at all. It may look like a sharp operator in a suit, walking into a company and saying, "Nice AI subscription. Now let's find out where it belongs." The big misunderstanding is that companies are, quote, adopting AI when they buy access to a powerful model. That is like saying you have modern aviation because you bought a jet engine and left it on the conference table. The engine matters, obviously. But airlines also need airports, pilots, maintenance crews, air traffic control, safety procedures, and passengers who do not panic when the boarding gate changes. Enterprise AI is the same. The model is the exciting part. The business value hides in the boring architecture around it. That is why the services layer suddenly matters. AI has to be connected to data, permissions, workflows, governance, financial controls, and employees, who may quietly be thinking, "Please do not make me learn another dashboard." This is why the recent moves from OpenAI and Anthropic are so interesting. They are not just selling sharper knives. They are stepping closer to the kitchen. OpenAI launched a deployment company to help businesses build around intelligence, backed by more than $4 billion of initial investment, and a network that includes investors, consultancies, and system integrators. Anthropic, meanwhile, partnered with Blackstone, Hellman Friedman, and Goldman Sachs to create an AI-native enterprise services firm focused on bringing Claude into core business operations. That is not a small signal. That is the model labs admitting something every serious enterprise buyer already knows. The product is not finished when the API works. The product is finished when the invoice department, risk team, sales team, procurement team, and slightly suspicious regional manager can all use it without breaking the company. Here is the deliciously awkward part. AI budgets are rising, but payback is not moving at demo speed. Deloitte's research found that most companies are increasing AI investment, and most plan to keep increasing it. But the typical satisfactory return is often a 2 to 4 year journey, not a 2-quarter miracle. Only a small minority reported payback in under a year. IBM adds another clue. More than 8 in 10 C-suite executives say functional silos block value. So the problem is not just the technology. It is the organization chart fighting the technology. Finance has one version of the truth, operations has another. Compliance wants auditability. IT wants stability. The business wants speed. And somewhere in the middle, the AI agent is looking around like a very clever intern who was given no badge, no manager, and access to nothing useful. That gap is the commercial opening. Whoever can turn AI from a clever demo into a governed operating system gets paid. This is where AI-native services become more than consulting with a shiny new label. The valuable firms will not simply show up with a deck titled, "Your AI Transformation Journey" and a suspicious number of triangles. They need to build the operating stack. Data has to be cleaned and connected. Workflows have to be redesigned. Agents need permission boundaries. Governance has to be built before the audit committee starts sweating. Employees need training that feels useful, not like corporate theater with a chatbot mascot. IBM's research is useful here because it names the hidden machinery: change management, AI governance, data governance, real-time integration, interoperability, and financial integration. BCG goes further and argues that agentic AI could create up to $200 billion in net new demand for tech services as companies move from pilots to scale. In plain English, the world may not need fewer consultants. It may need a different breed, less PowerPoint priesthood, more deployment engineering, So who wins this gold rush? The model labs want to move downstream because deployment protects relevance and captures more value. Consultancies and system integrators want to defend the enterprise relationship. Private equity sees roll-up potential because fragmented services markets have a habit of becoming very interesting when a new platform shift arrives. And startups will try to build narrow, repeatable solutions before the giants learn to move faster. The uncomfortable truth is that the margin may go to whoever owns the messy middle, the business process, the data plumbing, the risk controls, and the trust of the people who actually run the company. If AI models are the engine, AI native services are the mechanics, architects, translators, safety inspectors, and occasionally therapists. Not glamorous, perhaps. But in business, the boring layer often becomes the profit layer. That is the business undercurrent. The AI race is not only about who builds the smartest model, it is about who turns intelligence into operating leverage.